Today we're going to talk about financing risk in biotech investing. Financing risk can be more crushing than clinical risk, especially in a bear market like the one that we're in now. In a bear market that's so bad that many biotech stocks are trading below the cash they have in the bank, there are probably some bargain stocks out there. But when it comes to bargain hunting in biotech, there's a hidden landmine that can turn a home run return into a pretty big loss. That landmine is dilution and funding risk. But first, we need to just explain what dilution is. So we'll imagine a hypothetical company called Pie Company. They make pies. And let's say that Pie Company is valued at a market cap of $100 million. So there are 4 shares of Pie outstanding right now, and each share is worth $25 million a share. But the company needs to raise more money to fund operations and make more pies. They need $50 million or they will go bankrupt. So it decides to sell stock. To do this, they will add new shares and they will sell them to new investors. Essentially, the company's giving new investors a piece of the pie. But how big of a piece do these new investors get compared to the existing investors? So if they raise at $100 million, the pie is still the same size. But the company needs to raise $50 million in new stock. So the stock held by existing investors has to decrease in value to $50 million. So if the company is still only worth $100 million, they need to raise $50 million. So the 4 shares held by existing investors are now worth a total of $50 million, and the 4 shares held by new investors are worth $50 million as well. So that decreases the price per share down to $12.5 million, which is half the price they were before they needed to raise this new money. So this is bad for existing investors and for employees. So the quick pause here, we're almost done with the pie example, but the takeaway so far is raising money is good. Companies need to raise money to fund their operations, to grow value, to develop their products, but taking on too much dilution, if you raise too much money at too low of a valuation, that dilutes the value of existing shareholders and can be very bad for the company, and it can also be a negative sign for future investors. Okay, but a company has to raise money, they need money to operate. How can they raise money without reducing the value of existing shares? They can grow the pie. If they increase the valuation from 100 million to 200 million, maybe they come up with a new pie recipe and sells a lot of pies. Then they can raise $50 million and only give up 25% of the company instead of giving up 50% of the company, as in the prior example. So in this case, each share is worth $37.5 million, which is worth more than the $25 million they were originally worth. So this is why, if we take a step back, biotech companies try to raise enough money to hit what we call a value inflection point. So this sort of high-level graph here just shows how a biotech's company's valuation can increase dramatically if, for example, they have good clinical data or they get a product approved. And when they hit these so-called value inflection points, they can raise money on better terms, giving up less of the company to raise the amount of money they need to fund the business. Conversely, companies want to avoid raising capital before they've hit a value inflection point. So they always want to have enough cash to get to the value inflection point and then raise their next round on better terms. So now we'll go through a real-world example of how funding risk can hurt investors. And we'll look at this company called Huacapa Pharma. So they've had a pretty bad year. The stock's down almost 90% year over year, which is not uncommon for biotech, high-risk biotech companies last year. And this is just a quick snapshot of their pipeline. So they have an arenavirus platform. They're working on some immuno-oncology drugs and also working on infectious disease products. And they actually have a couple of phase 2 programs. So they're not just a preclinical story. They have some real programs going on in the clinic. I haven't done any diligence on this company. I don't know anything about their science. This is just an example. This is not an investment recommendation. But let's say that you've done your diligence on the science and you like it. You think if their phase 2 study succeeds, they'll get acquired for $1 billion. And you think there's a 25% chance that the phase 2 will succeed and they'll get acquired. So your expected value is $250 million. So these numbers are made up. I haven't looked at the science, just disclaimer. This is just for illustrative purposes. But assume that the expected value is $250 million, and then their current enterprise value is about $73 million. If you don't know how to calculate enterprise value, you can check out our video on that topic. So in this case, the upside is about 3 or 4x, which is pretty good. But that's not the whole story. We also need to understand, as we said, the company will get acquired after phase 2 data. So that phase 2 data is a value inflection point. So we need to know how long it will take to reach the value inflection point and how much it will cost to hit that value inflection point. And to do that, we need to introduce a couple of very simple concepts, burn rate and runway. So you may have heard of these terms if you've been looking at biotech investing or reading about investing on Twitter. But we'll just define them here and show you how to find that information. So a company's burn rate is the amount of cash outflow in a given time period, usually monthly or quarterly or annually. Just how much cash is a company losing or burning at a set time period. A company's runway is the length of time that a company can operate with its current cash balance. So to calculate the runway, you take the company's current cash and then you divide it by the burn rate. And that's just how long the company can operate before it runs out of money. So pre-revenue companies, biotech companies, they don't have their own profit. So that's why burn rate and runway are so important. They can't fund their operations with revenue, so they have to raise money from outside investors. And as we saw in the pie example, if you raise money at a high valuation, that's less dilution, and that's good for existing investors, right? You get more money into the business, you can continue to run the business and create value, and it doesn't cost you that much dilution to get that money. But if you raise at a low valuation, you have more dilution, and that is bad for the management team, employees, and existing investors. So you really need to know when you're looking at a company, what value can they create on their current runway? So we'll look at that for Huakapa Pharma. First, we need to get the burn rate and bring it out into more concrete terms. The burn rate, in its most simple definition, is the net operating loss in a time period. So the net operating loss is just the revenue minus the expenses needed to run the business. For biopharma companies, cost of goods sold, or COGS, SG&A, and R&D expense are the main expenses. And then if the company has significant non-operating cash outflows like capital expenditures, you account for those. But for the sake of simplicity, we're just going to go into the most recent 10Q for Huakapa and just look at the net loss for operations in the most recent quarter. So again, this is just on the 10Q, on the income statement, and it's just right here. This is going to be, you're going to see these same sort of terms for all pre-revenue biopharma companies. Loss from operations about 21.2 million. So just simply annualizing last quarter's operating loss, we got a burn rate of about 85 million. You can go to the 10Q to get the cash balance just from the balance sheet, and it just so happens that's about 82 million for Huakapa, which gives us a runway equal to about 1 year, 12 months. So that cash balance of 82 million divided by the burn rate of 85 gets us about 1 year of runway. So you have to be careful. You can't just extrapolate the historical burn rate into the future. So if a company, for example, just finished, a small phase 1 study that didn't cost that much, and they're about to start a big phase 2 study, then they'll probably have a higher burn rate in the future than they've had in the past. So you need to be careful when you're looking into this. Other ways you can get burn rate information are from, not just the financial statements, but you can look at the risk factors. Companies will sometimes outline their expected the runway and that part of the SEC filings. Also, you can look at corporate presentations sometimes to get a sense for that, or earnings call transcripts. And then you can also just benchmark if you can't find the information elsewhere. So if a company's about to start a phase 3 study in cardiovascular disease, you can find another company that did a similar cardiovascular disease phase 3, see how much that study costs, and then you can use that to forecast the cost of the study that you're evaluating. So here we'll just sort of back check the runway calculation. If you go to that same 10Q filing into the risk factors section, you can actually see here that they say their current cash and equivalents will allow them to fund the company for at least the next 12 months. So for this simple example here, we'll just use 12 months for the runway. So that 12 months started, that 10Q is in November, was filed in November of 2021. 12 months from then takes us into, Q3, Q4 of 2022. So what can the company accomplish in that time frame? So they'll have phase 1 data in their HPV program by mid-2022. And then they may have phase 2 data as well. Depends on whether, second half is the beginning of the second half or the end of the second half. And then they might also have an IND in prostate cancer. But it's kind of cutting it close for these milestones here. They may not have enough cash to get there. And biopharma companies really want to avoid needing to raise money like right before or right around the time of a binary event, because they may end up with very little leverage and have to raise money on pretty bad terms. So Huakapa is probably going to be needing to raise some money pretty soon. So they did in fact raise money, and now we're just going to kind of quickly go through some of their SEC filings to give you a sense of what they did to raise money, and then also where you can find this sort of information on how a company's raising money when you're looking at your own investments. So the first thing to look at is the stock price. So we saw that around the time of the 10Q, their stock was trading about $5 a share, but the stock has continued to fall. And as we mentioned earlier, if you raise money at a low valuation, that is very destructive to your existing shareholders. So they're having to raise money and potentially looking at a pretty low valuation that would be very dilutive. So just to illustrate what a declining stock price can do to hurt a company, let's say they want to raise $85 million to extend their runway for another year. So we said their burn rate for a year was $85 million. They want to raise $85 million to fund the company another year. So if they had to raise $85 million based on the November stock price of $5 a share, they would have to sell 17 million shares, and that would be 36% of the company if we assume, or because they had 29.9 million shares in November, and they need to sell 17 million more, which comes out to 36% of the total shares outstanding after this raise. So that's not great. In the bull market of the last 7 years or so, companies generally were able to raise follow-on funding to fund their companies for another year or so, and only sell like 10 or 15% of the company to raise that money. So after they go public, they're able to raise follow-on funding and sell 10, 15, maybe 20% of the company to keep the business going. So 36% is pretty bad. But if you look at what happened to the stock after November, it gets even worse. So that when the stock was trading at $1.25 a share, to raise $85 million, they would need to sell 69% of the company, which would essentially wipe out existing investors, heavily dilute management and employees, and just be very, very bad for the company. They really want to avoid this. So what could they do to alleviate this burden of dilution? Well, there's not a ton they can do because they're running low on cash and their stock price is low, but let's see what they ended up doing. So you can, again, just go to the SEC Edgar database, search for Huakaba, and then you can just look at all of the SEC filings they did since this 10Q, and you can see what they actually did to finance the company. And this will just give you a sense of like what filings to look for and what information you can get from SEC filings. We'll just quickly flip through a couple of these. So this first one here, the first thing that they did is in February, they announced that the CEO, CFO, and Chief Medical Officer, so 3 of the most senior people of the company, were waiving some of their cash salary in exchange for stock. So this is technically a way to reduce burn, and sometimes companies will, cut programs or do layoffs to save money and extend their runway. But if you're just looking at, 3 employees waiving part of their salaries, that's not going to get you $50 or $100 million you need. This is really just more probably for signaling purposes to just show investors and the rest of the company that management was confident enough in the company to not just stick around, because sometimes when companies are in these sort of tough situations, senior executives will leave and go to different companies and seek greener pastures. But these executives are not just sticking around, but they're actually putting more skin in the game. So this is just sort of a signaling mechanism. They probably did not want to do this, but given the company's position, maybe this helps them, helps their prospects of raising money. Another thing that they did, this is another 8K filing around this time, 2 weeks later, actually, on February 15th, is they entered into an amended and restated research collaboration and license agreement with Gilead. So what does that mean? So in June of 2018, Huakaba and Gilead partnered up to use Huakaba's platform to develop treatments for HBV and HIV. So Gilead's a big company in antiviral research, and they wanted to partner with this new company, Huakaba, to see if they could develop new treatments for those diseases with this new platform. So this is a common way for small biotech companies to raise money. They can raise non-dilutive capital sometimes by partnering with big pharma companies. So instead of going to investors and saying, hey, if you give us some money, we'll give you a part of the company. Instead of doing that, they go to big pharma companies and say, hey, we've got these products, we've got a bunch of different products. We want to keep some for ourselves, but we've got these other products where we can give you the rights to the products if you give us cash. So these companies, the big pharma companies, don't get any equity in some of these agreements, but they will get rights to certain programs in exchange for giving the smaller pharma companies cash. That's not exactly what happened here. You can read the SEC filing to see the details, but basically, Huakaba used this existing agreement they entered into in 2018 and went back to Gilead and said, hey, we need some money now. Can we renegotiate this so you get some money up front and then we'll give you something in return? And you can read this filing to see what exactly they got in return. But the upshot we'll focus on here is that Huakaba got $15 million in non-dilutive funding upon signing. And then they also did take on some dilutive funding. So they sold $5 million of stock to Gilead at $3 a share. And I think that was above the current trading price of the company. So this was actually a little bit better price than the company could get on the open market. And they also got the option to sell $30 million of stock to Gilead later. So not bad. They got about $20 million out of this. That doesn't give them the runway they need. But then they did this to fund the rest of the company. So this was kind of that big dilutive hit that we talked about earlier that they might have to do. But instead of selling 70 or 80% of the company, they sold a little bit less than that, but still more than 50%. So what they ended up doing is they sold 21.7 million shares of common stock for $2 a share. And then they sold 15,800 shares of convertible preferred stock for $2,000 a share. Now, these convertible preferred stock, if you're not familiar with the difference between convertible stock and preferred stock and common stock, there's some good articles online. I won't go into too much detail here. The only important thing to note is that each share of this preferred stock converts into 1,000 shares of common. So the effective price in sort of common stock terms for the Series A preferred is $2 a share. So you can sort of think of this financing happening at $2 a share. Now, the last thing I'll point out here is that the last closing price before they did this deal was $2.52 per share. So they had to issue this stock to new investors at a slight discount to the price they could get on the open market. And that's just because they're trying to raise a lot of money. The company's not doing too hot, so they need to give these investors a little bit of a sweetener to incentivize them to give them the $75 million that they need. So to summarize what happened here, Huakaba needed money, their stock price was tanking, and they did a few things to get capital. So they did a deal with renegotiated their deal with Gilead. So they got $20 million up front. $5 million equity investment, $15 million in initiation fee. And then they had the option to sell $30 million more to Gilead. And then they also raised $75 million. And they did this via a shelf registration, a takedown of their shelf registration. You can read more on Investopedia to get more details on that. And you can also read about the green shoe. So they raised $86 million if you include the green shoe. You can check out Investopedia for that as well. And if there's questions on that, just let me know in the comments and maybe I'll make another video on it. But the upshot is that they sold a lot of shares at a low price to raise that $75 million. So selling at $2 a share, that's better than the $1.25 they were trading at. And there's some natural volatility in the stock price anyway, so that might have accounted for some of the the difference between that. But maybe some of these actions that the company took helped them to raise at a slightly better valuation than they would have otherwise. So how does this affect existing investors? So we'll walk through a quick example here. Let's assume you bought shares in November 2021 when they were trading at about $5 a share. So let's say you bought 1,000 shares for $5 a share and your cost basis was 5,000. So that just in terms of the company's valuation, 29.9 million shares outstanding, the market cap at that price, 150 million, and the enterprise value is about 71 million. So now we're going to compare the returns in that scenario where we assume there's a 25% chance of $1 billion acquisition. We're going to compare the returns under that scenario with and without the dilutive fundraise. So here on the left, we're going to show the returns if you invested $1,000 in November 2021 at $5 a share, and then you did not have any more dilutive fundraise before the company was acquired. On the right, we're going to show that same investment, 1,000 shares at $5 a share, but this time they do a dilutive fundraise. In both cases, we're going to assume the same 25% chance of acquisition and $1 billion enterprise value. But the returns are very, very different. So you see here, if you don't do a dilutive fundraise, you get an 80% return. If you do a dilutive fundraise, you have a negative 28% return. So that's huge. And this is important because you can be completely right about the fundamentals of the business, completely right about the probability of acquisition and the acquisition amount. But if you get the fundraising risk wrong, then you go from a great investment into a terrible investment. And the reason is, if the company's stock price goes down, that doesn't necessarily mean you have a bad investment. If the stock goes back up, then that loss turns into a gain. But in this situation, when the company is forced to raise money at a low valuation, it basically locks in that loss, and prevents you from realizing the gain that you would have otherwise realized. And that's because there are more shares outstanding. So there's 75 million shares outstanding after this dilutive fundraise compared to 30 million shares outstanding beforehand. Now, you still own the same 1,000 shares. You still own the same slice of the pie, but the pie is divided up many more times here. So you got only 0.001% of the total equity value of the company after the dilutive raise compared to 0.003% without the dilutive raise. And you end up getting a return that is drastically different in both cases. And just a quick note here on methodology. When I do the equity value calculation, I assume the same cash balance in both cases, even though there's a cash generating fundraise in this example. And that's just because I'm assuming that the thing that catalyzes an exit is hitting a value inflection point, and then the reason for doing this dilutive fundraise is that you need more money to hit the value inflection point. So you end up in the same place, you just have to raise more money to get there in this example. All right, so what are the takeaways here? So generally in biotech investing, scientific, clinical, and commercial considerations trump financial ones. And good companies are able to raise in most markets and can generally raise on good terms in most markets where it's not too volatile. But in down markets, when investors are scared, that's when even good companies can get hurt and be forced to raise dilutive runs. Again, I haven't done any diligence on Huacapa. I can't say whether it's a good company or a bad company. I'm just using an example here. But even good companies can get hurt pretty badly in down markets. And in cases like that, financing risk can actually trump clinical and scientific risk. You can be right about all the difficult stuff. You can analyze the clinical data correctly, understand the unmet need and the market positioning. But if you get the financing risk wrong, none of that matters. But quality, the fundamentals, are also even more important in down markets. Investors are much more picky when the market is bad. They do more diligence and they're more sensitive about valuation. And all of the tourist investors leave. All the people who are just speculating or momentum investing, they're out of the market when it's volatile and in a down market. So fundamentals are really core when the market is volatile. And analyzing and understanding the fundamental scientific and clinical considerations are really, really important. On the other hand, financing overhangs can present opportunities. So if you had looked at this company, Huacapa, in November and said, hey, they've got interesting science, they've got a couple phase 2 programs, I think that they're really undervalued based on their fundamentals. But you notice there was this funding overhang, you could have just waited and seen how the stock played out, on what terms the company was able to raise, and then gotten into the stock at around $2 a share instead of $5 a share. And you would have been able to invest when the company had a full balance sheet worth of cash, instead of in the situation in November where they were kind of getting ready to be running on fumes. All right, so the higher level takeaway here, just focus on, as always, your scientific, clinical, and commercial diligence, but make sure you cover your bases with disciplined financial analysis. And then an important corollary to that we're not going to talk about too much is, in addition to staying focused and disciplined on the funding and financing risk, you also need to stay disciplined about valuation all the time, but especially in down markets. And the biotech market in general has lost its discipline about valuation over the last 7 or so years. And a lot of the pain in the market is a function of that loss of discipline. So hopefully this was a helpful video if you're going to look for value investments in biopharma now. Let me know if there's questions in the comments, and be safe out there.